Hey guys, Warner with Red and Black Academy, and today we're going to discuss how do you evaluate a business in 3 simple steps. Number 1 is going to be the operating margin, number 2 is going to be the cash flow margin, and then number 3 is going to be going through the 3 areas of the cash flow statement. So by the end of this video, you'll have a better understanding of how to evaluate a business quickly, to find the good businesses and avoid the poor businesses. So let's get started. What is the operating margin? Well, the operating margin is how much a business makes off of its operations. So that's cost of goods, it's cost of services, sales, general, administrative. How much is that business making? So say you make $100, how much are you keeping after your operational expenses? That's a key statistic because we want to know how efficient a business is at using cash. Take, for example, like an airline business or a commodities business. They're a very low margin business. There's nothing that business can do to drive the price up because there's no brand or there's no love for gas or love for an airline. Yeah, you could say Hawaiian or Etihad or some of the other Middle Eastern airlines which have phenomenal customer service, but at the end of the day, they are still running a cash intensive business with not a lot of room for error, as you could see during the pandemic. And as you can see in the oil and commodities business, when there are shortages or when there's surplus, it just fluctuates like this. So we want to avoid those types of businesses. And how do we find those businesses? Well, we look at the operating margin. I typically look for businesses that have a 20% operating margin or better. These are going to be your database businesses, your social media businesses, any sort of tech-oriented business that's cost of goods is really low. So for example, cost of goods on a really good quality business will only be about 20% of that $100. So they'll only spend $20 to produce that good or service, and then another, let's say $40 through sales, general, administrative. That leaves you with a 40% margin. Those are phenomenal businesses because they can weather storms, they can pay dividends, they can buy back their shares, they can reinvest in their business, they can buy other businesses, they can do so much because they have what? They have cash, and cash is king. So the first thing we want to look at is the operating margin, and you can quickly go to Yahoo Finance and then look for a company under its ticker, go look under the financial section and scroll down until you find the operating margin. So that's number 1. Number 2 is your cash flow margin. So after you've looked at the operating margin, which I forgot to say is on the income statement, then you're going to go to the cash flow statement. And I know, guys, this may seem boring, but if you're committed to creating wealth, then hang with me because this is the most important part of creating wealth, how a business performs. And when you get it, it will not be boring. You will actually look forward to finding these diamonds in the rough that create a ton of cash. And that takes us to the cash flow margin, which is how much cash does the business have in its bank accounts at the end of the year. Now, publicly traded companies will file this every quarter so you can get an update. But to keep it simple, in their annual report at the end of the year, how much cash do they keep on their books? So I typically like to look for companies that have an operating margin of 40% and then the cash flow margin is similar. And what does that mean? You take all the cash in their books and you divide it by the revenue. So out of that $100, if you have $40 in your book or $35 in your book, that's a 40% margin or a 35% margin. That's great because that tells us they have tons of cash. And when you have cash, you can do a lot of things with cash. When you're squeaking by like a commodities business, an oil business, or an airline business, just look when something goes sour in those businesses. When there's an oversupply of oil or when the sickness hit and no one was traveling. Airline business went boom, almost blew up. The only reason they're still in business is because they got subsidies from the government. So now let's look at the final one. Now you've determined your operating margin, then your cash flow margin. Number 3, we are going to go down the cash flow statement like a waterfall. And we're going to look at cash flow from operations, cash flow from investing, cash flow from financing activities. Now what we want to see, and my friend Mario Parzino, who's my co-host on the Red Black podcast, taught me this, is you want to see positive, negative, negative. Positive on cash flow from operations, which means they're making money from operations. Negative on cash flow from investing means they're taking that cash and they're going out in the market and making smart acquisitions. They're buying back their shares. They're doing all sorts of really good things. And then cash flow from financing, right? That's where they're either paying down their debt or they're raising more debt. They're raising more equity in the markets, all that type of grades. And I said they're buying back their shares. They're actually buying back their shares in cash flow from financing. So that's what you want to look for in those three statements. You want to look at cash, that underlying operations is good at creating cash, then they keep the majority of that cash, and then they're doing smart things with that cash. Positive, negative, negative. So that's it, guys. Those are the three simple ways to evaluate a business. I know I went a little in depth on each one. You could go way farther into it. But always remember, when you see a new stock or any asset and someone says, oh, this is the hottest new deal, think operating margin, cash flow margin, and those three aspects of the cash flow statements, which is positive, negative, negative. Thank you guys for watching. I appreciate your time, and I look forward to connecting with each and every one of you in the future. If you're not a subscriber, please subscribe, like, comment. That tells the YouTube algorithm to share this message with the world. Thanks again.